If you don't have good broker relationships, now's the time to be focusing on making sure you make the list. So now we're back into a long-term housing shortage.
You want to be an asset owner. If they could update zoning and we could start to build manufactured housing, I hope that we're on the forefront of that and we're actually participating in that growth.
They just don't really understand our industry at all.
We're finally getting to where we've been in the game so long that the picture's becoming really clear. Welcome back to another episode of the Cash Flow Quest. Sorry for the little delay, a couple weeks off, just schedule issues, but we're having fun. We're also doing deals, and I'll give a quick kind of overview of the manufactured housing community market. It's been interesting to see this year. I feel like deal flow in general is up. People have been able to have time to groom deals, kind of get them ready to start to think about transactions. Ownership groups seem to be, the hats are changing. Maybe some older folks don't want to own anymore. So last year we wrapped up the year with a couple of late transactions because of that, more like mom and pop family dynamics. But I would say I feel like there's a good chunk, maybe $500 to $1 billion of transactions in mobile home parks nationwide that are just getting, maybe from the back burner of prep for broker dynamics to get their stuff in gear, to then rolling into full-blown marketing packages and out to the logical buyers. So if you don't have good broker relationships, now's the time to be focusing on making sure you make the list.
I think too, just like treasuries, just the fact that treasuries have stabilized has also been able to be healthy, not only in our space in manufactured housing communities, but like asset class wide. Like more people are comfortable going to market to sell if they know that they feel more confident that the treasury is going to hold tight. We just saw so much volatility, not so much in the earlier part of 2025, but 2024 especially, right? And I just feel like it's been hovering and kind of bouncing between the 10-year. It's at 4 right now,
Yep.
which is kind of wild.
And
4 to that
seems
4,
to be
2.
kind of stable there.
Yeah, and it kind of seems like it's found its bottom and its top, and it's kind of bopping around between those two, despite everything that's going on in the headlines, which I think gives a lot of calm to the markets. And then, people always talk about like new Fed chair coming in. So there's like a lot of optimism. We'll see. I definitely think the dovish Fed chair coming in will be definitely would compress rates across the treasury curve, like you would assume, right? But who knows? It hasn't been very logical over the last, 10 years.
So what's your thought? Do you think that this is going to be a bigger year than last year or a slower year in overall, deal flow?
I'm sensing that there's a lot of funds. So if you asked me 5 years ago, what's going to happen with all this institutional capital in the realm of manufactured housing, I would have thought good luck ever getting that out. It's going to be trapped potentially. But what I'd say dynamic I didn't either understand clearly or whatever is the allocation is always typically a pretty smaller slice or a small slice of their total fund in the institutional side. So of 100 million or 200 million, they're putting 10 to 20 million or maybe up to 20%. So maybe 30, 40 million of a fund into manufactured housing in a given year. Well, when they did that year over year, had a hard time finding good deals over the last 5 or so years. It's been kind of a hit and miss on like total deal volume and this and that. So deals have traded, but it's been a little bit sparse. Well, all that stuff that got rolled up and consolidated in the heading into 2020 with lower interest rates, that's kind of starting to be on the later end of the hold. And they have a mess on their hands with multi.
Yep.
And so I'd say that's just a new thing I'm sensing is if you can get to the hurdle price and or the IRR hurdle for these institutional guys that have MH mixed with multi, you can break them off.
Yeah.
I'm sensing that's new inventory that I really wasn't counting on.
Yeah, because I think what happens a lot of the times with these funds is that they have like a 5 to 7 year hold period. And if you think about like what would be something that would be coming to market today, like the the vintage is like they always call like what vintage year is this fund, right? Like when they start buying.
It's a good vintage.
There's been some bad vintage lately. Some sour wine out there, man.
Exactly, right? So like, and so they always kind of like, the institution on the institutional side, like even just allocators like pension funds, they was like, oh yeah, like what like vintage year was that fund, right? And so you think it'd be like 2020, 2021 and going into 2022, which we all know what kind of happened. And so going to your point, and we've seen this personally, like through experience, is that people generally want to show wins on the board. So as long as it hits that return threshold, they'll sell their winners, which are generally the MHC that just didn't have the type of pressure that multifamily had. And then they can be able to show a win on the track record back to their investors, but then also provide some more liquidity back into the fund if they have other buyers within that fund that they need to kind of pad and start to like dampen, right? In terms of like capital calls or anything like that. You kind of want to sell a winner and not necessarily a loser, right? So
yeah, you want to offset. You want to offset bad news with some good news.
Correct.
Yeah.
Yeah.
and then keep the fund moving or sell the next vintage.
Yeah.
So, lead that into the next fundraise.
Exactly.
And the good news is MH is usually a winner. So like a lot of these groups have some winners.
You add in the dynamics that are occurring in the most of these equity groups or these institutionally backed groups are heavily in the stacked and invested into the multifamily sector. And so what's happening just from a staffing standpoint, like there's a lot of challenge on the horizon to just get through it. So I'd say something I'm hopeful about is you said a dovish Fed chair, which I think is just fun. Like, dove versus hawk, it's like the dove is going to be like really careful to not break anything. So they're going to probably, bring that overnight rate down. And I do think it was overly aggressive, what they did. Like they should have come up like halfway what they did and then started seeing where it went from there.
Yep.
So I'm hopeful for the guys that got caught with construction adjustable rate mortgages and stuff like that. Like they just really got put in a vice. So I hope that can alleviate some pressure just for Main Street, for people that took on projects, even smaller developers, and also for all the trades. Like it'll relight the trades and kind of get confidence back and really, the leasing efforts across multi, like it'd be good.
Well, you pulled it too, just because like you say, the institutional players are really heavy into multifamily, but it also just a factor is that the transactional volume, the size of multifamily is so much larger to that of MH. So it's not necessarily like they like multifamily more, right? It's just like if you're putting billions of dollars to work, you need to go into a large transactable market that has the scale. So you pulled the numbers last year. How much transacted in MHC last year?
Best you can figure, it's like $3 billion.
$3 billion.
But that's probably a little light just because that's like, there's a lot of unofficial transactions, but call it 3 to 5 billion.
Yep.
And multi's got to be 10x.
Yeah, easily. And multi had a really low transactional volume year last year, and it still would be 10x. Just because there's a lot more apartments out there than there are mobile home parks.
I just pulled it. So according to the U.S. housing market, it's over 21 million apartment homes compared to 4.3 million MH.
Okay. There you go. Yeah. At the end of the day, they can deploy more money into multifamily apartments way more efficiently, regularly, with the caveat of it being a tougher business now.
How do you think, just out of curiosity, this is just something that I've kind of thought of too with just multifamily, and then like we've been talking about, other asset classes with other operators like self-storage, not to like pursue, but just, what's happened to that asset class as well. Do you think like the social media and the fact of like, I don't want to blame social media, but the fact that any Joe Blow can pick up a laptop and start raising capital and buying multifamily deals because of the ability to offload third-party management, do you think that had any impact at all to just multi on compressing just returns and making things so tight so then people had to go to variable rate loans in order to get deals to pencil? I don't know. I mean, it would be a small percentage, but it's just kind of a thought.
So is the question, did social media?
Just influencers affect
not necessarily like
market?
influencers, but just the fact of like how competitive multifamily is, right? Just like, it's not just institutional players are playing in a much different, like, pool of assets. They're buying huge sky rises, 300 plus unit apartment, garden style, beautiful communities. They're buying like the big dogs that I wouldn't say like social media influencers are buying, but I'm just talking about everything how that flows down. Cause everything
I think it added a good handful of buyers, to put pressure on pricing.
Yeah.
That were stupid.
That's what I mean.
Like and then what happened is if you are a 506c or you have a fund that is regulated and you can spend ad dollars and you can use social media and you can run ads and you can like grow this following.
Yeah.
And you start putting like these juicy deals that you did in the first few years of your business. There's a lot of bad examples of guys that did this. They had a good core business to begin with, and the thesis was good, but they got in at a time that caused them to get so bullish on rent growth that their models were whack.
Yeah.
I feel like that's the issue, not necessarily like this new, internet age person. Although I do think there are a lot of people who got upside down in it.
But it did. You're not like broad picture. It's a small percentage, but there were some high flying guys that bought like 30,000 units that they raised money with really well positioned ads and social media ads. So and they didn't have the track record to back it up. So like when you can run ads, I'd be cognizant if you're an LP, just focused on track record and length of time in the game versus shiny.
Do you mind if I get comment just, and I agree, the switching gears, but in that same vein, just because conversations I've been having, and I think it's probably helpful to share this with like our listeners as well, who I would imagine are investors as well as GPs, but like right now, if you talk to any capital raiser, it's like, it's really tough to raise capital. Like we are very blessed. And, obviously we have a great crew of our investors that, believe in us, and we've been able to raise, more capital than we ever have and buy great deals. And it's a function of also our asset class. But if you are an LP right now, or like a family office, like you have all the leverage, especially if you're looking at doing, say, like co-GP deals, like ground up development, anything like that. If you're starting to get approached by operators, and smart operators too, people with track records, and they're like, hey, would you like to go GP this deal or invest in this, this fund? You got to know that right now, especially in that asset class, like you have all the cards and you can negotiate. And so like, I'll give you an example. Like, a friend of mine and one of our clients was sending me this deal and asked me my thoughts on it. He got approached to co-GP, and basically I combed through the deal and we're friends, and he just wanted my advice. Basically I was like, look, it looks like a great deal, skilled operator, but I think that the returns that they're projecting are a little light for that amount of risk, especially being a co-borrower and all those things. I was like, if you trust them and you like them, go with it. Go with your gut. But what I would do is I'd go back to them and I told them exactly what I'm saying now. You have all the cards right now. It's very difficult to raise capital. Why don't you go back and have them change these splits so then the returns look a little bit more in line with what I would expect on development? And they did. And they accepted.
Oh, nice.
Heck yeah, they did.
And now they're happy, right? Because they were like, and this is the first time they like these
risk.
guys.
They're accepting some meaningful risk doing a co-GP deal.
Yeah. And it was funny. I just had this call this morning with the gentleman, and I was like, how did it go? And he told me how it went. And I was like, see, I told you, just because it's just a fact, and I think from other operators that are in multi or doing development, like that asset class is going to do well. It's just having it's not having its moment in the sunshine right now, but like you gotta really lean into your key relationships and be able to get creative on if you want to get deals done, because the rent growth will come back. Everything that's been built will get absorbed. But it's just, man, did we pull forward a lot of demand and a lot of supply pretty quickly with an interest rate run like we saw, and those guys are just getting beat up. I mean, I talk to a lot of people, and anyone that I know that invests in multi and I ask them about it, they all are getting capital calls. They all are having a bad experience. And they're not investing with Joe Schmo. They're investing with pro shops. So no one was really immune to, it seems like, to this.
Yeah, you made a comment a few podcasts ago about how like the thing that was crazy about the whole situation was there were a lot of gray hair and white hair guys in there who had been through these cycles that should have known. And like, it wasn't a bunch of rookie mistakes. It was like experts making the call. And,
What the Fed did was honestly rude. Like it was. Like they really paced faster and went higher on their rate bumps than they ever have in both cases, faster and higher. And it just smoked everybody that had any volatility in their rate.
Yeah.
And it was so fast that you could not fix and refi fast enough.
Correct.
Because we had deals we were doing at the time where we were sizing, trying to buy deals. And as soon as I could get a quote, the rate would bump another 1/4 or 0.5%, like real time. So then
we were setting maxes in the contract.
I had to pivot to seller carry deals, which was pretty rare.
Yeah.
Because of that.
Mm-hmm.
And a haircut. Because we couldn't, like the pricing was changing dynamically real time. So they really, like they went too far because they broke a lot of stuff.
For sure.
So I feel for those guys that had a lot of floating rate paper. And now if you had all floaters and you're expecting rent growth to the moon, you know what? It is what it is.
Yeah, exactly.
Sorry,
you
it's
play
a bummer.
Fast and loose.
learn that lesson and go into fixed rate next time. Hopefully you can make it out of it. If you weather the storm though, here's the good news. If you weather the storm and you could, and it didn't break you financially as a GP and an operator.
Yeah.
The silver lining is the long term in that they killed production and they killed the machine for growing it again.
Correct.
So now we're back into a long-term housing shortage and the cycle continues.
I know.
Where the contractors and everybody are going to have a slow up and they're going to have to all wait around again until new projects can come out of the ground and it starts again. And so you're going to lease up over the long haul, but I do think it's 2 to 3 years of like challenging income growth.
Yeah.
Or, trying to get to your NOI figures is just going to be tough.
The rent growth's still not there.
But I just mean like, just getting to occupancy.
I know.
And keeping occupancy. Like in San Diego, we operate an apartment deal and we're at 90, 91. We're trying to get there, but we're throwing incentives. We're having fun because we're in a refi year, trying to do some fun marketing and different incentives. But it's hard to keep the occupancy in a very dynamic, like everyone's throwing months and weeks of rent. And so
I've heard like 5 months, 4 months, crazy. Like it's like numbers that you would never.
Those people are hurting.
Yeah, we're doing 2 months, and I feel like we offer, competitive incentives, but like not compared to what other people are doing
on the multifamily asset.
And we're running we flip between 91.5 and 92%. We're like 1 point ahead of market. And our rents are, I think, like 5% ahead of market. So I feel like we're doing good, but like we want to do better. And so it's been interesting trying to solve that problem.
Well, and everyone wants to hold rate. Everyone wants to hold the rental rate of a given unit. They don't want to go down. So they're more willing to give free months than a rate cut on the apartment rent. And so it's everybody. But so then if you can hold, what's going to happen is rent growth is going to continue in like 3 to 5. After that, it's going to go back up because there's going to be a huge demand. And no supply.
So circling back, because this whole conversation kicked off on, do we have more deal flow this year?
Yep.
Obviously, I think it's going to produce more deal flow when we're breaking out from institutional, these deals that we thought were gone. But what's your end take? You think we're going to have more deal flow this year than last year? Because last year was a great year for the company, 91 million in acquisitions. It was a calendar year for us. So what do you think?
I think deal flow in general is going to be up this year for sure across the industry. And then it's, can we and should we capitalize on it in different markets? Because I think given our markets historically, I think Phoenix and DFW are going to be challenging to grow at that level.
So
year in, year out,
So making sure you're sniping quality deals in
and
a
focus
busy
on
year.
good markets. Yeah. So then that's our goal, is to focus on more landlord-friendly markets across the country.
Mm-hmm. What are you feeling from our investor side? What's the general, how's the water temp with them, and how are they feeling about investing in this upcoming year?
Yeah, I felt it like from the beginning of this year. I mean, you guys hear me talk about it. There's like a buzz that's happening. A lot of people are moving capital. I can give a couple of different examples, but you're seeing folks that are they don't see a better option. And so they're like, okay, I really like and understand the affordable housing option of manufactured housing communities. It makes sense to me. The financials look good. these are good base hits and I'm not going to strike out. And so they're leaning in more. They're de-risking from California assets or other, let's just call it more regulatory type states, and selling rental properties, investment properties, and rolling that capital in with us. So we're seeing that. And then like the last thing I'm seeing, this is more on the ultra high net worth side where we play as well, is that you're seeing folks that generally are real estate operators or, are large family offices that allocate to a lot of different, let's call them GPs, if you will, where they're not seeing great deal flow as well. And for them to allocate their like own capital to do their own deals, co-GP, GP themselves, and or allocate to all these other different types of funds. And so then now we're having more strategic conversations with them because they see the rent growth that we have. And they're like, how are you getting that rent growth? Because we don't see it anywhere else. It's like I was having this conversation, the same question of ultra high net worth client asking me about this, like, what are you seeing on the capital allocation side? And I said the same thing, like I'm getting there's a lot of buzz. We're growing pretty significantly, having a lot of strategic conversations. And he's like, yeah, Ben. And this guy's, 70, 80 years old. He's been doing it very sharp, been doing it for a long time. He's like, yeah, Ben, because everything else sucks. And so, yeah, I mean, I think we're kind of seeing our time in the sunshine where, this asset class has the rent growth, can provide the returns, layer on the tax benefits. So I don't want to say we're immune, but we're just blessed in that where we're playing in. And I think too, like credit to like Blake and Jen, it's like I kind of think about this because I have these conversations with Blake as well in some of these strategic large meetings. And it's like, man, like, weren't you lucky for staying focused for 17 years?
Yeah.
It's like lucky is like, I use that with tongue in cheek, but like, I think being focused is really.
I wanted to buy some apartments when you could double the rent.
Self-storage or whatever.
I chased some deals over the years, but at the same time, it was just like, no, this is better.
Yeah.
So yeah. No, it's kind of crazy, and you alluded to it, but like I feel like we're finally getting to where we've been in the game so long that we're like the picture's becoming really clear,
vivid,
and how we can execute on it, and we're equipped, right? So like it's just, yeah, I get how those guys that are in their 60s through, they've had their cycle, and it's like, oh well, that was the heyday. If I was later in my life, and you're seeing it, you can see it, but then you don't have the chutzpah to go chase it and take it down and grow. Because it's like you already have amassed so much at that point. So there's a whole dynamic going on. Ownership, you kicked around responsibility. Like family members, who wants it? You either are a deal person or you're not. Like you're either a deal junkie or you're not. And so then there's a lot of older groups, older shops that have a bunch of different holdings that are trying to figure out what to do with it, who to hand it off to, how do they sell or get out of it, tax plan, do estate planning. There's a lot of things going on in the market.
Yeah, and I think too, like going back to Tide's point on deal flow, I think just like demographically, like the baby boomers, like aging out, because it's in the same vein too. Like if you're talking about just like on the capital allocation side, but then same thing on the deal flow side too. You're just seeing folks that don't, they're getting up in age, have done very well for themselves, and they're looking at like what's next. And most of the time they don't have someone a second in line to take over that responsibility, to where that's when that deal flow kind of hits our desk, and we can then kind of take over those operations and take over those deals and take them into the the next cycle or the next generation forward, like move it forward. So I do think that you have this institutional play, but I do think like demographics are very important, and a lot of people that own the key, like have the keys to these properties, are up there in age. And so I do think we're going to start to see a lot of like these more mom and pop type operations roll over, which will provide for great deal flow as well. Just from a factor of like, of just where demographics are and ages are, and people are aging out of being the owners, right? Of being the GPs, the operators.
I think we're going to see more of that continue to happen. But I will say, going back to the institutional conversation, they were buying heavy for like 8 years in our space. I remember when they first came, like the first couple MHCA events I went, it was like cowboy hats and pearl snap shirts. And then it was like the third year, it was all suits. And it was really interesting. And everyone's like, hey, these institutions are buying these deals and we're never going to see them ever again. And it's the worst thing. And everyone's all upset about it. Well, now they're trading and we're seeing opportunities. I mean, we bought some deals from institutions last year, and I do think that the amount of volume that is held by institutions is very large. It's going to be more, I think, than the mom and pops
Yes.
aging out. Because it seems to me like as we look at the data we get from our analysts, it seems like the lion's share is held by these large groups.
Well, like that's such a great point. Like if you look at a lot of other like competitors like MHC, like marketing decks, right? Like I'll like look at some, I'll sign up for the webinar or whatever, because I just want to see how they talk about their deals and see what they're doing. But like they always have that stat, like 90% of all MHCs are owned by mom and pops. And I know, and we know just by experience, at least in our sandbox, maybe that's true on like if they're lumping in like 10 unit, 20 units out in the out in the sticks.
The data's kind of weird.
Out in the sticks and stuff like that. That's not where we want to play. We want to buy institutional large deals in major metropolitan areas, right? But I just think that like that's not the case. I think you're exactly right. And like the 4 and 5-star parks have already been consolidated, right? So these are like the large publicly traded REITs. Like those are, for the listeners, we kind of range or we rate parks on a 5-star rating, multifamily for comparisons like class A, B, C, right? But we go like 1 star to 5-star. The 4 and the 5-star resort style communities, those have already been consolidated. Mostly. And those kind of, right. Most of them, right? Of course, there's mom and pop still out there. But where we like to play is that 2-3 star and then move it up a star, star and a half. That I think as just buying pressure comes down and as a lot of these things get aggregated, it starts to move down more into our range. And so I think you're exactly right, Tide.
And in core markets.
And core markets.
Everyone's chasing core markets now in the Sun Belt where there's no stickiness. If they don't pay you rent, it doesn't take you a year to get them out.
Correct.
But it is interesting because like it all comes down to quality. And I guess ultimately we're lucky to look at certain deals and go, they're, at this point in time, too small for us. But I remember we were setting rents in Tucson, I think it was last year or the year before. And I got a full data pull from all the, we had VAs call through, and it was like 500 parks in Tucson. And I'm like, 500 parks, and the average rent was like $390 or like $350. I'm like, what info is this? It's got to be wrong. And I'm looking at it, and Space Count was in there, and it was like, I forgot what the sort was, but like,
a lot of
75% were like 10, 15 space deals. And it's like, oh, that's not even,
so
we're not talking.
That's the data skew on like mom and pop owns those and the big shops own the 200 plus unit deals.
Yeah. Like there's 1,000 1967 Shelbys, but only a handful are worth a couple $1 million. The rest are sitting in fields of torn apart kind of thing.
Yeah. No, it's, I think at the end of the day, we're going to have some ripples. Also, it's hard to achieve deal flow at scale for those guys. So I've heard it time and time again. So, I'll go to MHI this year in Vegas and we'll check it out. The Manufactured Housing Institute event that they have once a year. It's the big one. And it's probably going to have the similar groups, but I feel like what's the tide that's turned lately is, to use your name, is that the brokers kind of got wore out by those shops. And if they don't need to sell to the institutions, they're not going to, because there's no clear line of sight on the relationship that will then bring that inventory back through the same brokerage. So there's dynamics at play that I think that if you work for institutional equity and you're trying to get in mobile home parks and you listen to this, you got to do a really good job of managing your relationships, or else that is going to continue to become a headwind stronger and stronger as you're trying to grow. Because the private groups are getting stronger. Yes. So it's just a dynamic,
Well, I mean, we did get a win for once, which was multi-tanking really affected investment committees making calls.
Yeah.
And people blowing out of escrows. And for the first time, because for years we've had the same offers as everyone else, but we didn't always get the look, because it's like, why would you sell to a mom and pop operator or a medium-sized operator when you could sell to a giant corporation that is going to come through for sure and not have any issues? That was kind of like the pitch. Well, now it's like you might be 3 months into your escrow and something falls apart because of someone outside of the relationship's control, where they're dealing with you. Like you're dealing with Blake,
yep.
And he's pretty easy to deal with. He's kind of laid back and easy to go with.
Well, yeah, and we've by raising money the old-fashioned hard way, friends and family, and just off a track record, not off of ad dollars. We have to do what we've said we were going to do, but also we've diversified our pool, because there's always some movement, right? There's always good news, bad news in different sectors, And so by raising money privately, you diversify your group of equity partners.
Yep.
And that's huge.
Yeah.
You know, because it's like you and I have kicked around, like it's an ebbing and flowing mechanism. The LP pool and the people that want to play. I had a really good chat with Ken McElroy, like a multifamily guy, does similar stuff to us, and he said the same thing. You want to keep going and growing your base and people that are interested in your deals long term, because you never know what's going to happen to the 10 or 20 active guys that were big with you over the last 5 years might not be the next 10 years. You know, it's
so true. And I think too, like when you build that trust over decades with clients, when there are cycles or there are opportunities, and say like the outlook on the news isn't great, but you're like, I know this is a great opportunity. You can pick up the phone and call a handful of people that trust you, and then that you've earned their trust, right? It's like the show me, don't tell me, and they believe in you and they allocate, right? So it's like that flexibility. It's like you can't have that with institutions, right? Because like, I'll give you an example. When I was at Blackrock, and I used to sit in those investment committee meetings when the acquisition team would bring and present a deal to the investment committee, and I would sit in, and I wasn't, a voting member. I was just a fly on the wall as one of the asset managers. So I would, if they bought it, I'd have to take it over. But what ends up happening is that even the investment committee could say, you know what, this looks good, I really like it. And then all of a sudden something can change guards at the actual like pension or the institutional level, where their portfolio is shifting, and all of a sudden it's like, okay, we were going to allocate this amount of money to, let's say, BlackRock in this space on this private real estate, like separately managed account that we had, and now we're not, right? And they pull the string. So that's how it happens. It's not just the
all the way through the end.
Correct. Yeah. So it's not just the investment committee, like these institutional shops.
It's really a challenging structure.
Exactly.
To operate in.
And then so it's not just the investment committee piece. It's then also who's actually writing the check, the pension funds too, which then they go and report to them. And so it's all these different layers. And then just to add on just one more layer that you just don't see in the private side is that you got to remember that all these people we're talking about, they're W-2s. So they're just employees, and they come and go.
For sure.
And so even at the pension level, the CIO for Cal Stirs or New York Commons or Texas Teachers, or like you name it. So those folks, it's not like it's not their capital, right? It's not like working with a family office that you built a long-standing relationship that they believe in you and they write the check, right? And they're very upfront, like, here, this is what I want to do. This is my return thresholds. And if you hit this, and we'll do it, right? You have that certainty that you're going to receive that capital too close. And so it's always a changing of the guards too. And so the appetite, some new guy can come in or new gal, and it's like, maybe I don't have the same flavor or the same like risk appetite, or I want to do something different because I want to try to get promoted. And so that's the politics and just the stickiness if you run it all the way up the food chain on the institutions.
That is crazy. All right, we're going to jump into some of these news stories. So first thing on deck is U.S. CPI drops to 2.4%, boosting rate cut expectations.
Yeah, this is a tricky one. My initial impact when I hear that is like, really, is it gonna cause the Fed, even the new guy coming in May, to reduce rates? So you kind of have to think through it. But it does seem that if the inflation is and CPI is cooling, then you would start to get leery of, does it cool too much, where the velocity of dollars just on Main Street start to slow up. And that's the key here. And Trump knows this. That's why he's leaning on all aspects and controls on the economy. Throttle. Because he's trying to make sure we don't fall off step. Like in a boat when you're cruising along and you're up at cruise versus when you get settled back in and the butt kind of sinks down. The shop. It's hard to get back up to step.
Yep. And so,
the economy, you don't want to let it slow down too much. So if we are nosediving on inflation, which this is kind of I'd say one of the earlier indications, right? Like there hasn't been that many where inflation is kind of steepening its downward
It's been trending lower and it's coming down. I mean, gosh, just in I'm probably gonna screw this up. Was it 2021 where it was like 9%?
I bet you there's a chart where it seems like this is the first time where we're into the mid twos healthy.
Yeah, and
it's been at 3,
and
right?
and it's getting closer to target, which is 2%. And I think the Fed is completely, and everyone is completely on board with using a 2.3 or 2.4% and saying like that is a good like neutral rate, because usually it was always 2%. You want dual mandate. We've talked about this before. 2% inflation and like full employment, which is generally like an unemployment rate of, let's just say like 4%, right?
Yep.
4% or below, like 3.5%, 4%. So if you have those two levers, then the Fed says, okay, the economy's in good shape. So we've got unemployment that is sitting in an okay spot, but then like now as you're starting to trend to see inflation come down with this dovish Fed chair, I think it gives them ammo to be able to cut and justify that they're not going to let inflation run by cutting interest rates. Plus, I think there's so many other things going, like exactly what you just said. I think that's really like beautifully said, just with like the boat analogy. I didn't even really think about that, but it's so true. It's like if they keep the front end of the rate of the overnight rate too high, it is going to really like stop the downward effects of employment in terms of all the trades and just all the stuff that happens when interest rates are above what I would say like a healthy rate for what asset prices are at. And I'm sure we'll go into housing as well. So I think that this is all really good news, and that the Fed cutting rates, I think they also have an issue on their hands with like just the amount of debt that we have. I don't think we could run high interest rates just for our ability to service our debt. That's a huge issue. And so I think that this is all going to trend lower. Now, what happens to the longer end of the curve, like the 10-year treasury and beyond? Who knows? Because the market dictates that. But
to Trump's credit, I think it's more important to get the short term down as I'm sitting here thinking through it, because that's where all the construction, boots on the ground, that's production, that's everything that's more project, future growth based is typically priced shorter term on SOFR plus a spread, and that's your all in rate. And it's been it's like 7 to 10% depending on the risk and what you're doing.
Yeah.
And that's just so much from where it was. So like get it back down to maybe, I think it's like 3.5-ish right now.
Yeah.
Get it back down into the 2s, get everything kind of settled down. I think he wants to keep going from there even further. But then see what happens with Treasury, see what happens. Like they also are now starting to manipulate Treasury purchasing and all that from the Fed side. And so, but make sure that the production, construction, and all those like day in and day out, like working Americans don't lose forward production. Yeah. Because that's where now nobody's buying anything.
And to like, just as we're like spitballing here and thinking through it, it's like, and I don't have the data to back this up, but I would imagine too, like, if you just think about like 2008, like when it hit, like how long it took for us to finally get back to start building. So like once you shut down crews, and you know this, you come from a construction background, it probably takes a long time. So you don't want that boat to start dragging, because it could take a lot longer to then get up to step, as you said, because, you know, it's like you start from square one again.
It's actually really crazy. I had just a little piece of a snippet of what happened in the front end of my career when I was 20, 2010, 2011. We were the first to come out of the ground in San Diego with a meaningful multifamily property development down in Chula Vista, and the plumber was taking jobs. He was a scaled plumber, big plumbing subcontractor that does all the plumbing in these big multifamily developments. He was taking jobs and bidding them to win so he could lose $1 million and keep his crew. Yeah. So at that point, he's drawing on company reserves to just keep his guys fed. Yeah. And to your point, like that's real. Like you have all these guys that are staffed up in these crews that are trades guys, and they roll up for a big contractor or subcontractor. You got to keep projects on the table, or else the whole machine stops. Yep. And so he lost money, a couple of trades. So like we smoked that, but that wasn't necessarily intentional.
That was the market pricing.
That was my family surviving. My dad was a developer, and my dad goes completely blind. So I got tapped in to become the developer eyes, let's call it, you know? And so I just happened to be along for the ride on this whole project while we were buying mobile home parks. But the bidding process for all the trades kept coming in lower and lower. And it was like crazy.
There's that deflationary topic that you just said too, right? Like
You got to keep the engine at least at a baseline idle. You know, and that's where Trump fully gets that because of his construction background. So that's where we're running the risk right now. Is like the engine is at probably idle, but then the forward 2 years forward planning, it looks bad.
Yeah.
So to answer a couple questions that were thrown out in this dialogue, number one, in June of 2022, it was 9.1% inflation. So that was the peak during the pandemic. After the great financial crisis, the GDP, it took 3 years to bounce back, but employment took 6 years. It dragged.
Oh, that's an interesting stat to keep in your back pocket. Yeah, that's basically what we're saying.
Yeah. So once you stall out, it takes years to come back. Is what that data's saying. And
then housing didn't catch back to its peak until 2016.
Yeah, it took a long time. So that's the argument. If I'm sitting in a boardroom or whatever, if I'm a multifamily developer, I'm looking for really opportunistic properties that I could buy out and buy myself 2 years of development, like taking over land, taking over stalled construction projects at really good basis, well below replacement cost of whatever you're buying. Knowing that, hey, I want to buy 2 years of this because I think that at this time, and just project, modest rents. But I think you're right, Blake. Like you wait 2-3 years and this thing all kicks back up again and you start to see that rent growth, which would be great for our industry as well, because we're playing catch up on all the rent growth that happened over the last 5 years, call it. So we're going to run out of space too. So we need these guys to go run again,
We got to do a little video on like mobile home park rents and like a rabbit is multi and it's like, but then it just wadded up and it's like licking its wounds, trying to figure out how to get back up. And the turtle, it's like, we're not actually like really generating these massive returns, is that we're just still moving forward.
Correct.
And then keeping up to where the rabbit was, and then we'll just go a little bit beyond, and then the rabbit will be back spooling up and take off again. So it's like we're just keeping up with what happened already and truing our rents up to that same dynamic, is that same level of disparity between multifamily and mobile home parks. And so it's just an interesting time to see that whole thing in real life. And
can we make that video?
Yeah, sure. AI, baby. We can make anything.
Exactly.
So Goolsbee signals more rate cuts possible. That's a Chicago Fed president. And so, I think that's what's going to happen. If you're watching the news, that's all this administration wants. And I think that's a primary lever that they're going to use to achieve what they want economically.
And just like, not to cut you off, but just like something that comes to mind as we're talking about all this, but like you want to be an asset owner.
Sure.
It doesn't have to be mobile home parks, but if you're hearing all these, okay, they're going to cut rates and, the Fed's probably going to introduce some new monetary policy. They have a lot of tools.
New QE,
they could do a lot of unique, different things. I never underestimate the Fed, what they can do and just all the monetary tools at their disposal. But like, what does this all mean? It just means that inflation is going to run. The money printer is going to get back on.
For sure.
You need to own assets, because if all of this does happen, as we're kind of like reading the tea leaves, it's like, oh man, don't sit in cash because you're scared, because you are going to be left behind. And that's the worst thing for a lot of baby boomers and just retirees that are on fixed incomes and stuff like that, sitting on cash, and treasury yields are their main kind of form of income. Those are compressing down. CD rates are compressing down. It's just like asset prices are just going to continue to inflate, and we're either going to grow our way out of this debt or this problem, or we're just going to print our way out. And hopefully we grow it out, because it's much more economically impactful to grow out versus just inflate out.
I think that this administration thinks it's going to be a mixture of both.
Yeah, I agree.
They know that they're going to print. And ultimately, I think they're a little bit hopeful that AI causes major productivity increases and all these things here in our economy. So it's all interesting. I think the bottom line is this is further backing into our underwriting and kind of showing like the projections, the forecasts we have for rent growth, and
it's giving us
our
downside
model
protection.
Is going to be pretty safe and probably conservative, if we're being honest. All right. I think, we talk a lot about gold. We're all gold bugs here at Comfort Capital. Broke 5Gs, $5,000.
Yeah, it ran hot there for a minute, like 56, almost 5,700, I think. 5,600. Silver had its spike over $100. So pretty interesting times on that. And I think it's really important to note, like you said, hold hard assets. The big catalyst I keep pointing to, but it is the critical component to this, was we broke our word and our trust, the United States, by seizing the Russian capex, or what do you call it? Foreign exchange, actually. Yeah. Foreign forex. When they had a conflict in the world, we took their hundreds of billions of dollars, to a couple $100 billion, and iced it. And we captured it from them and did not allow them access to those funds, which is just a catalyst for everyone in the world to not want to hold dollars in the dollar system. Instead, they want to hold something that's tried and true and trusted, which is gold and silver. Silver's more of a speculative game. So I think the institutional growth to gold from more of like a hedged reserve is what's happening there. Central banks, if you don't believe me, the key thing I just watch is any data viewership towards what the central banks are buying and holding as reserves. And it's like, well, if the central banks are holding X amount of percentage as reserves, that's what I want to do.
Yep.
Because they see it.
Yep.
They see the whole picture.
Did you guys hear about this Russia huge deal with the U.S. that they're talking about, linking it with the Ukraine war? I don't know how to pronounce it. Dimitrov package. So it sounds like it came from them. This just happened this month. But they're proposing a $12 trillion economic framework to the U.S. linked to an end of the Ukraine war. It includes concessions in lifting sanctions, but also working to use the U.S. dollar for transactions, reversing previous de-dollarization policy.
Interesting.
So that just came out.
That's from Russia?
From Russia. This is what I'm seeing right here under U.S.
That must be. We'll have to dive deeper into that to know it clearly. But
yeah,
that would be an interesting pivot if Russia was like, "Hey guys, let's regroup here."
Yeah. Well, I wonder too. Like you just saw that, like Xi Jinping and Trump had that hour-plus long call, and Trump came out and said it was extremely positive. But then also, I read the transcript from Xi Jinping, or like the China Republic of, the Republic
CCP,
of China, CCP, because it's Chinese New Year, right? And so
you're the horse, or something.
Yeah,
like that?
You're the horse. I don't know what that means, but and he was very positive too, or that China was very positive. So I do wonder. We've talked about this, like if everyone like looks at our debt problem and our issues, but we're like the shining star when you look at everyone else.
For sure.
So I wonder if there's just going to be this consensus, like, hey, look, like we all can blow each other up like 100 times over.
How about said we just blow up our currencies, inflate out of this,
or just like, hey, let's collaborate, right? And like that, which would be great, and like have some of these strategic partnerships, like with guardrails, right? We, like we saw through COVID, like we were so dependent on medical devices and really everything with China and other countries that we didn't produce anything ourselves. And so who knows? I mean, we only have a couple more years, 3 more years of Trump, and we'll see the next administration, but it would be great to have like not necessarily globalism as the way that it was always portrayed, but like the idea of like
collaborative nationalism.
Yeah, exactly.
Global trade settling down and everyone kind of, playing to each other's strengths.
Yeah, exactly. Right.
And we get that. Cat's out of the bag on how much we were dependent on China. So it's good. But like China doesn't need that.
Yeah.
They don't need masks and penicillin.
No.
Like we can make that. It's not going to break them. Like there's things where it's just like, come on, let's work this out. Exactly. I agree. I'm really hopeful about that too.
Very cool. And did we want to cover anything else on gold specifically? I thought that whole like it was pinging, we're not going to get into conspiracy theories, but like it went to 5,600 and then Epstein files drop and then it dropped and there was some weird short on silver.
Like that whole dynamic where it ran up and then like fell off a cliff on a Friday night when everything was off. Businesses, like the cycle was over. And like over the weekend basically opened up an opportunity through like Monday open where the big banks could get out of their squeeze, because they had like leverage positions that were against them. And so it's pretty interesting. It's a lot of, it's borderline conspiracy theory, but it did happen. And it's like, well, why did it happen? It's kind of unclear.
Maybe another topic, a couple mobile home, 3 mobile home park guys. Should we go,
it's moving on. Yeah. That's what happened. And it was interesting, but then it kind of settled back down,
Okay, so we collectively think that gold will go to 10 an ounce. When do you think? How soon do you think we see gold at 10,000 an ounce?
I think in the next couple of years. Probably not this year.
Couple years.
I would say, yeah.
That's bullish. What do you think?
I think 5 years is, but I agree with Blake. I think it's going to continue to go up, and it's all because of the reasons why you outlined. And a lot of really smart people think this way too, not necessarily gold bugs, but it's really just the dependency on the dollar. It's just a lot of the holdings across other central banks of more gold. And I think just also too, from like the day-to-day person, I think that there's kind of now this reliance on like, oh man, they're printing more of these dollars. Inflation continues to go up. I want to hold something physical and something that is tried and true. And so I just think that more people are going to hold and stash gold, which is going to continue to keep an upward price momentum. I just don't think it's going to happen as fast as it's happened now. I think that what's happened has proven the concept. And now I think it sticks around, kind of like what Bitcoin happened,
Oh, I was just thinking we gotta talk about Bitcoin. So like, when are you guys buying your Bitcoin?
I'm not buying Bitcoin.
Blake, didn't you get a hot tip to buy it at 80K if it falls at 80K?
Oh no, it was a 7 handle, so that would have been 70K something.
It's there right now, right?
It's at 67, I think. You can pull up the current day, but yeah, I mean, gold versus Bitcoin. There's a lot of chatter on the internet.
Well, I heard too.
66.
I think it's going to go down. And if it gets under 20, I'll buy one just for fun.
I'm with you.
I just feel like Bitcoin, this is my personal take. Everyone here knows it. I think Bitcoin is fully based off of like consumers talking and thinking they're going to make a ton of money off of it. In no intrinsic value, in my opinion. I don't think it has any utility in the market. And I personally am not going to invest in it. I'll invest in companies that own technology related to Bitcoin.
Because I think that blockchain, right? Yeah.
Coinbase is a smart play in theory when you're talking about cryptos, but it's down right now. Like what's interesting is everyone's argument has been so far when it was ripping, like it's the same as gold, and then that's like been the argument. And I love that it's a B in a gold coin. It's like, well, okay, let's see what happens, and then gold and silver rip, and then something kicks off, whatever the catalyst was, and it's down. So like there are crypto billionaires. If you did that, good for you. But I think those guys are probably buying gold.
Well, people made millions off of NFTs. That doesn't mean an NFT is a good investment. And that's my take on it.
So then I've been hearing that like Ethereum is the blockchain that's going to actually feed real production in the tech side.
For the Litecoin and
the the use case dynamic. So it's going to be interesting to see. There's the chatter I've heard lately that kind of I think rang true a little bit was it's a modern day casino, and when liquidity and people are challenged financially, people stop gambling as much.
That's interesting.
And so they're pulling. And so if you have, let's just say like everybody's got like I don't know let's just pick 10 grand. Like if you had 10 grand in crypto, or you made 10 or 20 grand because you started really early, you're pulling money because that money means a lot to you. Like these people aren't, globally speaking, across the wide percentage of these crypto owners, they're not significantly wealthy off of it.
Yeah.
And if their job turns or tanks, or they have to redo something else in their life financially, they're going to pull. So I think we're going to see a massive decline from here because of people not wanting to lose all of it.
Well, if you are a crypto billionaire, millionaire, reach out to me. I'd love to help you protect some of that capital.
With fixed assets. With fixed assets. We can honestly help you a lot on the tax side and everything. I hope you got out before now.
Yep.
But if you're sitting on cash and you have gain, talk to us because we can just help kind of walk you through some of the dynamics we're seeing.
Yep.
So then the next story is U.S. House passes Housing for the 21st Century Act. That's 390-9. Bipartisan legislation aims to address the chronic housing shortage by modernizing federal housing programs, reducing regulations, and supporting zoning reforms, including measures to support manufactured housing as an affordable option. The last piece is directly relevant to us.
Yeah, I love that. So
Yeah,
did you
really
pull
cool.
the details of exactly?
I didn't know.
So-
Ben, I think, had been doing some.
Well, yeah, no, I didn't pull up a lot of the details. I think that's massive news. I mean, we just got that today, but I didn't realize that this was going through the House, and the fact that, there was some bipartisan support and the House supported it. I want to look into the details, but I know Scott Turner, who's the head of the housing department in the federal government, is a big supporter of manufactured housing. We've talked about it 100 times here on this podcast that we believe that this is the true solution to the affordability crisis, just given the fact of how cheap we can bring in HUD approved, high quality homes to consumers. And I think this would be massive. If they could update zoning and we could start to build manufactured housing, I hope that we're on the forefront of that and we're actually participating in that growth. It'd be very exciting. It would be one of those things where, you hang your hat after you're 80 years old and, look back at your career and it's like, yeah, like I helped build more housing and in an asset class that I was passionate about, that I thought was a true, solution to the affordability crisis. So we'll see. I'm going to dig into it, but I don't have any context on what it's actually going to mean.
Yeah, it says some of the stuff that makes sense to me right off the top is it modernizes HUD's home investment partnership program, increases FHA multifamily loan limits, and establishes new grants for regional and local affordable housing strategies. That all sounds good. Looks like there's a lot of stuff having to do with what is qualified as an MH. There's the bill eliminates the permanent chassis requirement for manufactured homes and establishes HUD as the primary authority on construction and safety standards for manufactured homes.
Wow.
Which is a massive shift. Removing the chassis requirement would expand what qualifies as a manufactured home, potentially opening up new product types for communities, streamlining homes and how they're built and placed. So
Love
interesting.
What on zoning? So zoning, I think we were just talking about this internally. Zoning is the biggest issue. What's causing the holdup? He's like, why can't we build more? It's a local zoning issue. So it's not the whole country, has this issue. It's the fact that all the cities don't allow for us to build these, even on the outskirts of growth anymore.
Mm-hmm.
It's really difficult to get them approved. Now, if they know that and they lean on, kind of like the ADU thing in California, if they do the federal, like they lean on the states to pass something that allows us to build them by right, versus having to sell the city and get a vote, because it's not a great high density use of land, but it's affordable housing. So, okay, let us go out a little bit further from the city hubs and build them. And yeah, that'd be cool if there's some grants or something. But the key issue is just letting them get approved without really having to know somebody and have somebody on payroll to get it through the city. It's like
the other key piece too, if I don't know if this is going to touch it, but just removing that chassis requirement and what is a manufactured house and having it just as long as it's approved through HUD, like what that light bulb that pops up in my head is that if you can get some sort of traditional financing on these homes, because for people that don't know, it generally goes through what's called a shadow loan. It's 8 to 9% plus interest rate. And it's because they look at it as higher risk because it could, roll off because it's mobile, but it's really not. It's set on stanchions. It's not moving. The statistics are there. Like once a home is set in a community, that's like a 2% probability it's ever going to be moved. But if they can be able to not even necessarily give like a new loan product on it, which maybe they probably would need to, but if they were able to securitize this paper, meaning be able to provide liquidity on the secondary market, that would allow markets to do what they do best, which is price that risk efficiently. And that would bring down those interest rates, which would immediately have a massive impact to consumers in terms of affordability by driving down interest rates, because these things are getting packaged and securitized and sold on the open market, where Wall Street and normal day people can then price those loans, and competition just allows for, just more efficient pricing. It could bring down those interest rates on those loans. So that would be
Yeah.
Huge.
That's huge.
There's only like 4 primary chattel lenders and a handful of regional banks. And so I wish it was 8 or 9% average. It's like up to 12% for our end consumers sometimes.
But they hold this on the balance sheet, right? They have to hold it on the balance sheet. So they have to get, they have to get a rate that is sufficient to running that business. But then if you're able, so like.
I agree completely. I'm agreeing with you. Yeah.
And I was just saying, like, the difference between Fannie and Freddie with multifamily or single family homes is that Fannie and Freddie don't sit on all those loans. They package them up and sell them to the open market, where pension funds and sovereign wealth funds and, Wall Street, everyone buys and holds those loans and holds it for yield and returns. That doesn't happen in the shadow loan industry. And so you're removing the most efficient pricing model there is, which is just public markets, to be able to then price it efficiently.
Amen. It's a big issue, which it mentioned at FHA, which is a key component to that.
Yeah.
And for them, I think, because we've kind of talked with some industry insiders before on this, what they were struggling with is they just don't really understand our industry at all.
Yeah.
And it would be really simple if you set quality guidelines for the park and you set year guidelines for the home inventory, and you can even put some type of addendum that the home can be moved off of the property for a certain period of time unless paid off in full or whatever. And maybe there's some type of PMI that is involved with specialty manufactured housing. But ultimately, there's a way to solve it. And if you could get FHA loans with like 1 to 5% down payments on brand new mobile homes in communities, there's such a pool to buy that. And it's a great affordable housing option. Where I get a kick out of this is, how are they not hitting this home all the time? Because both right and left collectively agree on this. Everyone's like, we want more affordable housing. You have an option that's been here, since the end of World War II. Figure it out.
Yeah, I agree. And also, like, just from our standpoint too, like we do like land lease communities, right? We're the landlords and they pay space rent, but we're like talking about this industry, why this should happen even for folks that are looking to actually own the property, right? Do like almost like condo fee simple land, where they're buying land in communities and setting the homes. It just makes sense, not even from a business standpoint for us, where we plan, and Blake and the team, we've all talked about, it'd be cool to even just build manufactured housing communities and sell them fee simple too. Like if that's where the opportunity is, and you're helping the economy and helping people get affordable homes. We just believe in it that much that it's not just like self-serving to us in the sense of land lease communities. I mean, it's just, this is, if you talk about in what I've learned coming onto the team and spending a lot of time learning from you guys, is like, this is the biggest constraint on the market is the loan products for people to buy their own homes.
I think it's worth noting that if you buy a home and land package, or just a manufactured home that's now kind of converted to a modular, you pull the frame rails off, you have it on a piece of land, you have utility connections and stuff, you can sell those. That is actually a product you can do.
Oh, really?
And you can, that is a transactable security.
Fannie, Freddie, FHA,
Yeah. FHA does them.
Pitch roof, attached garage, and a fixed foundation are the 3 requirements in order to qualify for a conventional loan for real property.
And so we just had a guy on the podcast specifically about that. And obviously it's harder to do here because of just the raw land cost is way more. But still, you can do it here for like $400,000 or $500,000. Lots, couple $100,000 home out here. People spend more money on homes than we spend in Arizona and Texas, but you can get a home for $100,000 to $200,000. You're in it once you have utilities and everything for $400,000 to $500,000. In South Carolina, the guy we had on the podcast is doing it for under $200,000.
Wow.
Yeah. So land, having to boot up fully.
Does it have to be ground set?
No. So ground set is also a term for pit set, and that's if you dig a hole.
Got it.
Basically, instead of just setting it on grade.
Yep.
So
like almost like footers.
But you can, in this scenario, you can leave the frame rails in. I'd say it just adds a long-term use, let's just say quality of the experience to set it on block versus having the frame rails there. Because the frame rails allow vibration. So like if somebody jumps, you hear it on the other side of the house. Whereas if it's block, it just grounds that noise and vibration.
But wouldn't you think what if
you learn something new every day?
Wouldn't you think that
I like block set, and pulling the frame rails, and all they do is they engineer up all the flooring.
Yeah.
And so they use 2x6s instead of 2x4s, but yeah.
But like some of them do masonry all the way around, and then they put the piers in concrete. I feel like you would get sound, would be dampened in that scenario.
Yeah.
I don't know. It's getting really cool. We went and saw a Barndo triple decker. That deal was so
Barndos.
cool.
It was a triple double.
It was a triple double, but it was 2 stories. I mean,
It was triple wide on the bottom and double wide on top.
So cool.
All right. Well, let's end it with news regarding our bet. Probably the most important thing happening at this company right now. We'll give you a little snack first, Ben. NAR calls it a new housing crisis as January sales tank 8.4% from December, slowest since December of 2023, and the biggest monthly drop since February 2022, according to CNBC.
Yeah, and I think too, like, and people have probably seen this stat, but you pulled it up because I asked you to pull it up before this, before we jumped on. It's like there's 47% more sellers than there are buyers, and I kind of figured that's why we made this bet. So the bet is Tide's kind of poking fun at me, but I'm still in the game that we bet on if housing prices last summer, if they're going to go up or down in San Diego. So we had to pick a market. We didn't go nationwide, which I should have because I probably would be more in the money. But we picked San Diego, and I said they're going to go down, and just from a factor of affordability is the only thing I looked at. I wasn't doing any sort of speculating, rather than just saying that housing prices have stayed pretty stable and interest rates have gone up precipitously, and so that would just tell you that housing prices need to go down or interest rates need to go down. So what I'm saying is actually coming, what I said last summer is actually coming true nationwide. We'll see what that does to housing prices. It's really tough. I was pretty dumb, and I said that they're going to come down 5%, which is, I don't think they've ever come down 5% year over year in San Diego. So I'm probably going to lose this
MBA from
bet.
Blackrock, okay, guys?
Yeah, but
So yours was that they're going to come down 5%.
Yep.
Let's say, have they come down across the country?
I'm not sure. Let's see.
Because I feel like maybe a few percentage points.
Well, if that holds true, that there's 47% more sellers than buyers, they're going to come down. Like,
and
that's
so
a
you
fact.
might not. I think if you were talking nationally across like tertiary markets, I don't think your 5%'s crazy.
Yeah.
Crazy.
Yep.
Might not hit it, but it wasn't crazy.
My entire bet was that they were going to go up because interest rates were going to fall down, and I thought that we're going to start to see it run. And I think that is coming. And then this leads into the next story, which is housing affordability hits 4-year high. January's decline in mortgage rates pushed housing affordability to a 4-year high for the first time since 2022. It's the first time since 2022 that the consumer is saying it's less than 30% of their income for the housing payment.
Yeah.
So I think rates are now in the 6 realm, like maybe 5, 8, 6-ish, 6%-ish. So that does help just bring the payment down.
I still think prices are going to come down, though, because I think what happened was even when rates went up, there's still a lot of people that were in the buyer's pool that were just like, we got to buy a house. We got to buy a house. Like, we want to buy a house because it's such a, excuse me, it's not a financial decision. It's really an emotional.
Yeah. I think your odds are better in a place like high growth Texas.
Yeah.
Versus San Diego.
I agree. I should have picked DFW.
Like places where they allow people to build houses. You can't build anything here.
Well, that's true.
So like you have just that pent up demand.
Well, hopefully we both lose.
And then, no, not hopefully. You give me a bottle of bourbon.
Hopefully they just stay flat or just go down a little bit, to which I know Ty's not going to give me a concession and say, oh, they went down, so I'm going to give you
a concession. It's $100.
That's a bottle of bourbon for this one.
Well, okay, $100.
Yeah.
$200.
All right, $200. All right. Well, what else?
Better not be 4 roses on my desk.
Let's wrap up.
That's pretty much it.
I think we covered it, and we'll more to come. We've obviously you can tell we have a lot of fun around here. It's what makes the game and the grind fun day in and day out. So I hope you enjoyed this episode of the market dynamics, kind of a Q1 manufactured housing and kind of global market conditions. So, all right, see you next time.
Thanks, everyone.